Hello there. Welcome back to Grade 10 Accounting. In this video, we want to look at the preparation of the income statement. And our question is got 42 marks and it requires you to spend on average 33 marks. So this is what we have in our question. And our question reads that the information provided below is extracted from the records of Vili Collections. Their financial period ends on 31 December 2019. The business uses a profit markup of 60% of costs. Complete the following financial statements of Vili Collections for the year ended 31 December 2019. So on the required part, it reads, prepare the income statement, and it has got our 42 marks. So we are given the information whereby we are given extract from the trial balance of 31 December 2019. So this is going to be our extract from the trial balance for the year ending 31 December 2019. So we are given a balance sheet there with a debit column and also a credit column. So these are the balances that we are given, starting from land and building going down. So if you go down, you'll see that beneath this balance sheet section, you are also given your additional information that you are given there in terms of adjustments and additional information ranging from 1 going down to additional information number 11. So you need to go through all this additional information one by one and try to understand them so before you start to answer the question, because as there are adjustments that you are going to make there that are going to require the information that are in the additional information. So going to our answer section, you'll see that we have got a in our answer book, we are given the question 2 in the income statement. That is the income statement for Vili Collections for the year ended 31 December 2020. So this is information that we have. So you just need to fill in. So we are given the sales as our initial item that we are going to start with. So on sales, we are going to check the figure that we are given for sales in the balance sheet, and then we try to see what adjustments do we have that are affecting our sales figure. Remember, if you've got adjustments that we have in the additional information also that is affecting our sales, we need to adjust the sales figure. And also we can look for other adjustments in the trial balance that we are given there. Remember, we are going to look for sales returns that are going to reduce the figure for sales in the list of balances that we are given. And also we look for debtors allowance, again, meaning the same thing. Debtors allowance and sales returns are meaning the same thing. If you have got those, we need to subtract them so that we get the net figure for sales. So if we have adjusted for those, we can also go to additional information to see if we've got anything that is affecting our sales so that we can adjust before we move on to cost of sales. So we go there. We go there in the question and try to see the figure that we have for sales, and obviously we find this figure under the nominal account section. So this is what we have in terms of the nominal account section. So on the nominal account section, our sales figure is 400,380. So before we check this figure, we need to find out if we've got any returns in terms of sales returns or any debtors allowances. So it is that we have got debtors allowances that we have here, which is 1,980. They are going to reduce the figure for sales. So going to additional information again, we need to check if we have got anything that is affecting our sales figure. So we can just try to check from additional number 1 going down to the last additional information. But if you go carefully, you'll see that there is nothing that is affecting our sales. So the only figure that is affecting our sales is the figure for debtors allowances. So remember, debtors allowances, they are the sales returns that are going to reduce the figure for sales. So we are just going to say 400,380 minus 1,980 on the other section. Then you get the net figure for sales. So we go to our answer section. So on our answer section now, we are now saying the figure that we have for sales is 400,300. And then we subtract the one for debtors allowance, 1,980. So we do as such, you're going to see that the figure that you're going to get there, representing your net sales, is going to be 398,400. So this is what we have. And then we have got our cost of sales. So for our cost of sales, again, we go to the question to try to find out what we have in terms of cost of sales. So cost of sales, we have got an already given figure, which is 240,000. But we know that there is a formula that we use to calculate cost of sales. In the event that the figure for cost of sales is not given, you have to use this formula which says cost of sales is equals to opening stock. You add this is opening stock, or you can say opening inventory, meaning the same thing. You add your purchases, you subtract your purchase returns, or you can that's called them creditors allowances, and then you are supposed to add your carriage inwards if they are there, carriage on purchases, the carriage on inwards, and then you are supposed also to add your custom duties if you have them, and then you subtract your closing stock. So this is the formula that we can use. So when we don't have your purchase returns, just ignore them, and we don't have maybe carriages, you just have to ignore them, and then you subtract your cost of sales, and so that you arrive at your so you subtract your closing stock. Sorry, here it means our closing stocks. Then we subtract your closing stock, and then you arrive at your cost of sales. So this is what we have. So in this case, we are only given the figure for cost of sales as calculated. So we're just going to take it as it is, 240,000. But obviously, before you take that figure, you need to go to additional information to find out if you have got anything that is affecting your cost of sales. So if you go through, you are going to see that we have got nothing that is affecting our cost of sales. So it means if you have nothing that is affecting our cost of sales, we are going to take the figure that we are given in the list of balances as it is. So we are saying cost of sales is cost of sales, we are given it as 240,000 here. So we are just going to take 240,000 and go to the additional information and put it as 240,000. So here we are saying 240,000. And remember, we are supposed to subtract your cost of sales from your sales so that you get your gross profit. So here we can subtract and show by putting our brackets. So let's say 398,400 minus 240,000, we are going to get 158,000. 158,400. So this is what we have, and then we can go on to the next item, which is other operating income. So we are going to the question and try to identify the incomes that we are given in the question. We come here, we check under the nominal account section which incomes are listed there. Remember, rent income is income, commission income is income. We are having those, and discount received also is part of our income. So if we are checking those typical items, we go down, checking them. So you see that we've got rent income, which is an amount of 20,800. Another thing that you can try to make your life easier is that our incomes, we find them on the credit side, which is this side. And that's where we find our income or expenses are on the debit side. So this is what we have. Then in terms of our rent income, we have a total of 20,800. So the figures that will be given here under the nominal account section represents the actual amount that was paid for that particular expense or income. In terms of expenses, we are saying that is the total amount that was paid for that expense. In terms of income, we are saying it's total amount that we received for that income. So in this case, we've got rent income. We are saying we received 20,800 as rent income, but it doesn't mean the rent income belongs to this period. So we can only find out about if there's any adjustment needed to be done on that rent income if you go to the additional information. So if the additional information is silent, there's nothing about rent income, it means we assume that this figure that we are given in the list of balances is the same figure that belongs to that period. Remember, we'll be trying to comply with the matching principle or the accrual principle, which says we should only record the items with the amounts that belong to that period. What doesn't belong to that period, we remove. That's why you adjust for accruals. We are saying accruals, we're saying that it is the amount that belongs to this period. But if it's an income, we are saying it's the amount that we're supposed to receive, but we haven't received it, so it becomes an accrual. So we add it. And for prepayments or in advance, we are saying it's something that we're supposed to receive next period, but we receive it in this period, so we remove it. So because it doesn't belong to this period. So that's the essence behind the matching principle or the accruals principle. So for rent income, now we are saying we are going to the additional information. We are trying to see if we have got anything that is affecting our rent income. So we start from the information number 1 going down, and we'll see that we have got. Let's try to see if we have got anything that is affecting our rent income. Right. If you go to item number 10 here, it means rent has been received for 13 months. So what does it mean? It means the figure that we're having in the list of balances is for 13 months, of which our financial way is supposed to have 12 months. So it means there's an extra month that is there that we received the rent of the following period. So we need to remove that rent. So we can only be able to find out the amount by dividing the amount that we have in the list of balances by 13. And then we can remove that monthly rent so that we can be left with the rent, which is supposed to be for this period only. So we come here. Our rent income, we are saying the amount that we are having is 20,800. So we are saying going to say 20,800 we divide by 13. We can calculate it as such. We say 20,800 we divide by 13, and the amount that we are going to get is 1,600. So having 1,600 means we are it is also the rent for the extra months that that belongs to the next financial period. So we're supposed to subtract 1,600 from 20,800. So we go to our answer section. So under operating income, we are now saying rent income in the brackets, we are saying 20,800 and we subtract 1,600. Close bracket, good. If you calculate correctly there, you're supposed to get 19,200. Then we go again to check other income that we have in the question. We go again to check if we have got other incomes that are there in the question. So after rent income, we go down checking again. We have got commission income here, which is 19,000. So obviously, we also want to see if you've got anything that is affecting on commission income in the additional information. So we go there. So we can go there item by item again, trying to see if we have got anything that is going to affect our commission income. Right, if you go down, on the last item, which is 11, an amount of 1,000 is still outstanding for commission income on 31 December 2019. So when it is still outstanding, it's still owing at the end of the period. We haven't received it, but it belongs to this period. So we are supposed to add it to the one that we are given in the list of balances. So 1,000, I'll add it to we add it to 19,000 that we have here. So we'll say 19,000 plus 1,000. So we go to the other section. So here we are saying commission. Commission income, and then we are saying 19,000 plus the 1,000 that is outstanding, and you're going to get your 20,000. Then this is what we have. So we can now add. It means we have exhausted all our operating income. So it's now saying 19,200 plus 20,000, and then you're going to get your 39,200 here. So this is what we have, and then now we are supposed to calculate the figure for gross operating income, which is supposed to come here by saying gross profit plus other operating income. So we're saying 158,400 plus 39,200, and then the total for gross operating income that you are supposed to get there is 197,600. And then we go to the section of our operating expenses. Of course, the total of operating expenses is going to come here. So we are just going to list them. So we have got some operating expenses that have been pre-entered. So if you go down, you'd see that we have got wages and salaries being pre-entered as 65,000, and telephone 4,050. Donations as pre-entered again 4,000. So we check for other expenses that we are having in the question. So we go to the nominal account section and go again item by item, trying to check all expenses that are going to be listed there under operating expenses. If you go down, you'll see that the first expense that is there is water and electricity, which is 4,950. And of course, before you enter it, you go again to the additional information and try to find if you got anything that is affecting water and electricity. But obviously here is clear. We have got number 4, water and electricity account for December 2019 has been received, but not yet paid. The outstanding amount is 450. So we've got an outstanding amount for water and electricity, which is an OI, or we can call it an accrual. So when we have such a scenario, that amount we have to edit. So remember, we're saying it belongs to this period, but we haven't paid it. So we are going to add the figure that we have in the trial balance. We add our 450. So we come here. Water and electricity, we've got 4,950, and then we add our 450 on the other section, so we can go there. So we are saying water and electricity. Water and electricity, and we are saying the figure that we have in the list of balances, we are having 4,950. And we are adding our 450 to get our total of 144,790. Sorry, if you add, we're going to get your total of 5,400. If you add, you get your total of 5,400 here, which is 4,950 plus 450, and you get your 5,400. So next, we can go and try to see which is the next expense that we are having there. So after water and electricity, we've got advertising, which is 5,900. So for advertising, again, we go to additional information to check any adjustment affecting our advertising. So we've got a clear one that we are seeing there, item 6, which is here, which is saying advertising includes an amount of 1,400 for a 4-month advertising contract. The contract runs from 1 November 2019 until 28 February 2020. So we are saying November, December, January, February. Then it ends for 4 months. Like stated here, 4-month advertising contract. But you know that this year is ending. Let's just check where the year is ending. We are seeing that it's ending on 31 December 2019. So this advertising amount is stretching to 28 February 2020. So it means January and February are outside this financial period, so we have to calculate them and remove it. So it's 1,400 and it's for 4 months. So to get for 1 month, we are saying 1,400 divided by 4. And calculate like that, you're going to get your 350 per month. And this 350 per month, you multiply it by 2 to get for 2 months. You're going to get your 700. So 700 is for January and February. So it's inside this 1,400, which is inside the total for advertising. So we have to remove this 700. So we are saying total for advertising that we have is can just recheck. We have here advertising 5,900. So 5,900, we subtract the 700 that we calculated. So we come here. So we are saying advertising. So we are saying 5,900. We subtract your 700, and then the amount that you are going to get is 5,200. And then we go to the next item from advertising. From advertising, we've got insurance, which is 3,890. So for insurance, again, we need to check again if we have any other item that is affecting our insurance. And the amount that we have for insurance is 3,890. So we go to additional information to check anything that is affecting our insurance. If you come here, see that on item 5 is saying the amount of insurance includes an amount of 800 paid months for next financial year. So this one is clear. The advance payment is 800. So we have to remove it. It doesn't belong to this period. So we are going to subtract from 3,890 that we are given in the list of balances. Remember, we have 3,890. So we go there. So here we are saying insurance And then in brackets, we are saying 3,890. Then we subtract your 800. And then the answer that you are going to get there is 3,090. So after insurance, I will go and check again what do we have. So after insurance, we are saying we have got rent income, which we adjusted under income. We leave it. We've got vehicle repairs, which is 3,300 here. So we can go to our internal information again, checking anything to do with the repairs. So if you come to item 3, an amount of 11,800 rands paid for repairs to one of the vehicles was debited to the vehicle's account. And next sentence, correct the error. So what happened here is this amount was for repairs, but we didn't debit. Remember, we're supposed to debit the repairs account as an expense, but we went to debit the vehicle's account. So we have to remove it from the vehicle's account by crediting vehicle's account, and we debit the repairs account. So it means in the repairs account, we are going to add the 11,500, which was 11,800, which was omitted. Then again, when we are now calculating depreciation, we have to take note that there's 11,800 that we have to remove from the vehicle's balance because it's inside the vehicle's balance. The cost price of vehicles, we have got to remove 11,800. So we will adjust that when we get there. So, but in this case, we are going to add our 11,800 to our repairs. So we recheck the amount for repairs. We have got vehicle repairs 3,300, and then we add our 11,800. So we go there. We are saying repairs. So we can say vehicle repairs. And then for vehicle repairs, we are saying at 3,300. We add 11,800. We add that we are supposed to get you 15,100. And then we're going to check the next one. So after vehicle repairs, we put commission income, which is an income, we skip it. We go to stationery. So the figure that we are given for stationery here represents stationery that was bought for the period. But we need to check the stationery that was left at the end of the period. Remember, the component of expense of stationery that we are going to consider in the income statement is the one that was used. So to find the figure that was used, we say the balance that we given in the trial balance minus stationery that remained there at the end of the period. Then we get stationery used, which is the amount of the expense. So here we bought 4,520. So what remained at the end of the period? What remains at the end of the period, we can only find it in the additional information. So if you come here, stationery, we are seeing that 950 is the one that remained at the end of the period. So we subtract it from what was bought and find what was used. So we are saying 4,520 minus 950. So we can just go and summarize that one on the other section. So we are saying stationery. And we are saying 4,520. We subtract 950. And we are going to get 3,570. And then from there, now we go again to check what's the next expense that we are having. So from stationery, we've got packing materials. So packing material, obviously, we are going to use the same approach that we used on stationery to say 2,110 represents stationery that was bought. And then we check stationery that was left during the period. If we have nothing, it means we're going to take it as it is. But if you have something there, at the end of the period, we subtract that figure to get what was used. So we go there. So packing materials, we are seeing that we've got 340 at the end of the period. So we are subtracting that 340 from the figure that we're having there, which is 2,110 to get the component of what was used. So we come here. So we are saying packing material. So in brackets, we are saying 2,110. And then we subtract 300. We subtract 340. That we had at the end of the year. Then the answer that you are supposed to get there is going to be 1,770. Then from packing materials, obviously, we go and check again what we have next. From packing material, we've got interest on fixed deposit. So this is going to be our interest income, which we are going to adjust after getting our net profit. Obviously, we are supposed to, after getting our operating profit, we add our interest income. That's why we are adjusting this interest on fixed deposit. So we go to additional information. Remember, we've got some expenses that we want to find out in terms of that won't be stated in the nominal account section. For example, we've got trading stock deficits. We have to calculate that one. And also, if there's provision for bad debts, again, we have to check it. It won't be stated in the nominal account section, but you can only be able to find about it when you go to additional information. So in terms of our trading stock deficit, remember we say book value of stock, and then we multiply the physical stock count figure. And the answer that you are going to get there, if it's a positive figure, it represents a deficit. It means our book value is greater than our physical stock count figure, which means we've got more in our books than what physically on the ground. So it means it's a loss. So we regard it as an expense. A deficit, which is an expense. If it's a surplus, to get a negative, it means it's a surplus. And we should put it under other income. So let's try to find out how we can calculate that one by book value. Now the book value, get it in the list of balances. So if you come here, you see that we are given your trading stock here is 6,580. So this is your book value. And then we check if we've got any adjustment that is affecting the book value. You go there and try to see. Right, it's written the owner withdrew stock to the value of 1,072 at selling price before the physical stock taking was completed. This transaction has not been recorded. So these are drawings which took place of 1,072, and we are saying it was at selling price. So the figure that we adjust in the stock there is this figure for the cost price, because stock is recorded at cost price as stock. The goods are recorded as at cost price as stock, and this one is represented in selling price, so we need to reduce it to cost price, and then we can be able to adjust it. So we are supposed to subtract it from the figure that we are given in the list of balances, because it was not adjusted, because these goods went out and we are not subtracted from the stock that we are having. So to calculate it now, we need to go back to the formula which says to get your selling price, you say your cost price plus your markup. So we have got a statement that we have at the beginning of the question, which is saying the business uses a profit markup of 60%. So we now have a hint. So if you come here, come back to our formula, it means our markup is 60%, and cost price is always 100%. So it means our selling price is 100 plus 60, which is 160. So we are now using simple proportion so that we can be able to find our cost price, which is represented by 100%. So our selling price is represented in this case with 1,072. So we want our 100%. So a simple proportion that we are going to use there, whereby we are saying 1,072 is what we don't have here. 160. 160 is what we have here with a given figure of 1,072. 100% is what we don't have. So we just use the simple proportion by saying what we don't have is 100% numerator, what we have is 160 denominator, and then we multiply by the given figure 1,072. We calculate it as such, you'd see that the figure that we're going to get there, is 670. And 670 is going to represent the cost price. So this is now the cost price. And this is the figure that is going to represent the cost price of these goods that were withdrawn. So we have to subtract 670 from the book value that were given in the list of balances. Then after subtracting it, we get a net value that we compare now with the physical stock count figure. Remember, the physical stock count figure is this one. Trading stock, we've got 4,300. This is our physical stock count figure. So we are saying the balance in the trial balance minus the cost price of the goods that were taken out, and then we get the figure for the book value. And then we subtract the physical stock count figure, and we see if we are going to get a positive figure or a negative figure. So here we are starting from the figure that we are given in the list of balances, which is our 6,580. So we go down there. But obviously, we are going to get a positive, which represents a trading stock deficit. So here we are saying trading stock deficits, whereby we are saying the figure in the list of balances, 6,580, the book value. We subtract 670 to get the book value after adjustments. And then we subtract the physical stock count figure, which is 4,300. And we get a positive figure of 1,610, which is representing a deficit, which is an expense, and we put it there, which is 1,610. So this is what we have. So it means now we are left with our depreciation. So we go there and try to see the figure for depreciation. But we can only be taught about how to calculate depreciation in the additional information. That's where we check. We come to the additional information number 9. Depreciation is calculated as follows on 31 December 2019. Equipment 10% on cost. So equipment, you're just going to say 10% on cost. So we can go and calculate that one. We know that there are no additions during the period, so no adjustments are going to make on the figure for equipment that we have. We have got for equipment, we are having, let's just try to see. Equipment is given as, we are given equipment at, equipment at cost, it's here. So it's 100,000. And then obviously we can recheck in additional information if you have got any other equipment that was bought and was not recorded. We can start from the beginning, going down, checking if you've got any equipment that was bought and was not recorded. Then if you go to our additional information number 9, you see that there's nothing that is being stated there about that equipment. So it means what we have there represents the cost. So equipment is saying 10% on cost, of which the cost is 100,000. So you're saying 10%, which is 10 over 100, you multiply by 100,000. So obviously you calculate it, you're going to get your 10,000. So we have got 10,000 for depreciation for equipment. So you now want to calculate for vehicles. So you go to your information again, you check the instruction for vehicles. Vehicles is 15% on diminishing balance method. So remember, when you're calculating depreciation using diminishing balance method, it's equal to percentage multiplied by the carrying value. But first of all, you have to calculate the carrying value, whereby you say carrying value is equals to cost of that fixed asset or non-current asset, subtract your accumulated depreciation. So first of all, you have to calculate carrying value. Then now you say 15% of that carrying value. So before you calculate it, remember we have got an error which transpired, which we need to adjust first, of that repairs amount of 11,800. So we can go back there and try to check it. Here they are saying an amount of 11,800 paid for repairs to one of the vehicles was debited to the vehicle's account. And we are saying this is inside the cost of the vehicles, 11,800, which we need to remove first so that we get the correct figure for the cost for vehicles. So we get there, we will say our cost for vehicles, we are having it here, 211,800. And then we subtract 11,800. And obviously we're going to be left with 200,000. So this is the cost of vehicles. So now to calculate the carrying value now, we say cost, which is 200,000, minus accumulated depreciation for vehicles, which we are given here is our 40,000. You see it? 40,000, accumulated depreciation on vehicles, 40,000. So we subtract there our 40,000, and you're going to get your 160,000 as your carrying value. Remember, the formula says percentage times carrying value. So our percentage, remember, is 15%. So we're going to say 0.15 as a decimal, 15%. And then we multiply by the carrying value, which is 160,000. So let's try to calculate it as such. And you are going to get your 24,000. So it means depreciation for vehicles is 24,000. And then we add it to the depreciation for equipment that we got as 10,000. So we go to the additional information. Let's just try to see on the other section now as we try to update that depreciation. So we are saying our depreciation. So in brackets, we are saying, let's try to see the figures that we got there for depreciation. We say 10,000 for equipment, plus our 24,000 for vehicles. So we get that, we add them, we are going to get your 34,000. So it means we have exhausted our expenses. So we can just go there now and add all the expenses that we have, starting from our wages and salaries here down to our depreciation. So we try to add there and try to find out what do we get as the total. So if you add there, the total that we are going to get there is 142,790. So this is the total that we are going to include there. So let's just try to see. So here we are getting 142,790. And then we are saying total for operating expenses, we show it in brackets as we are subtracting it from our gross operating income. So we are saying our gross operating income, 197,600 minus 142,790. You are going to get your operating profit. So let's just try to get down. So if you calculate it correctly, the operating profit figure that we are supposed to get here, it's going to be, let's try to calculate it and find out what exactly do we get. If you say, your 197,600, which is your gross operating income, and then we subtract your operating expenses, which is 142,790. You're going to get your 54,810. So here we are saying 54,810. And then after that, now that's where we are going to add our interest income. And now for our interest income, now we have interest income in the list of balances. Which is saying interest income, interest on fixed deposit is our interest income as we described here. That is going to be our interest income. So we described it here as our interest income, interest on fixed deposit. And then 2,000 means this is we are saying our interest income that we are given in the list of balances represent interest income that was received. But what belongs to the period, we can only find it when you calculate. Remember, we calculate it from the figure for fixed deposits. So we are being told here that the fixed deposit that we have is 10% per annum, and we're having a total of 40,000. So to get the total interest income, we're going to say 10% times 40,000. So we are coming here, we are saying 10%, which is 10 over 100 times 40,000. We calculate it, you're going to get your 4,000. So this is the total interest income for the period. But what was received is only 2,000, as we are shown here. It's only 2,000, which means there is an owing of interest on fixed deposit or interest income of 2,000. So on the other section, we are going to represent it as 2,000 plus 2,000 so that it reach the 4,000 that is for the period. So this is what we have. So you can go there. And we are saying 2,000 plus 2,000 is our interest income calculation. Plus 2,000, and then you are going to get your 4,000. So we are saying 4,000. So interest income, we add it to operating profit. So if we add there, we're going to get your 58,810. And then we now go to the interest expense. Right, for the interest expense, we come here, additional information. We are given here on item 8 that received the following loan statement from Royal Bank. Balance on 1 January, we've got 130,000. Capitalized interest is the one that we are looking for as our interest expense. And then repayments during the year, including interest, 40,000. Then balance, which is the closing balance on 31 December 2019 is 105,000. So we are going to use this information to find the interest expense by saying opening balance of the loan plus the interest capitalized, that is the interest expense. And then we subtract repayments, including interest, and then we get your closing balance. So we can just substitute to the figures that we have there. Opening balance, remember, is 130,000. Interest capitalized, which is interest expense, is the one that we are looking for. Minus repayments, we are given it as 40,000. And then for the closing balance, it's 105,000. So we say equal to 105,000. So we want to make this subject with formula whereby we're saying interest capitalized is equal to 105,000. Then we take 130, the other side, it becomes negative. It becomes minus 130,000. 130,000. And then we take 40,000, which is negative 40,000, the other side, it becomes positive, plus 40,000. We calculate it as such, we are going to get the correct amount of interest expense of 15,000. So our interest expense becomes 15,000. This is the amount that we are going to put there. So we come here, we say, I'll just summarize the working. Just summarize the working brackets, and then the amount, the net amount that you're supposed to get here is 15,000. And this one is we are subtracting. It's an expense we are subtracting. So we're saying 58,810 minus 15,000. And then the answer that you are supposed to get here is a positive figure of 41,000. Let's try to see. If you say our 58,000, let's try to see 58,000. 58,810, and then you subtract your 15,000. You are going to get your 43,810. So here we are saying 43,810, and obviously this is our net profit for the year, because we are getting a positive figure here. So this is what we have according to the preparation of the income statement. Hopefully the video was helpful. Let's subscribe and share. Those who have subscribed, please subscribe and turn on the notification button so that we get notified of the new videos that are going to come as we prepare for the exam. Let's share the video to all our friends who are concerned about retain accounting. As for this video, I'm signing out. We'll meet again in the next video.